So I came across this interesting article this morning, or early afternoon, on the Acting Man blog, and the title of the article is "Don't Be Another Wall Street Chump," and it's by M.N. Gordon. So basically, what this article is saying, Brave giving me ads. What this article is saying is that markets have highs and lows, and don't buy at the top, and don't be a chump. So it has got some interesting commentary here. But basically, the thesis is that price matters, and what you expect going forward is going to depend largely on what you pay in the first place. So the goal is to buy equities or whatever, bonds, whatever it is. You buy, you have whatever cash flow while you own it, positive or negative, and then you sell. So the buying price is one of the most critical parts of all that. And he talks about the Shiller PE ratio, a cyclically adjusted PE ratio of the CAPE, which is the way that works, if you haven't seen it before, is it takes the 10-year, the past 10 years, and compares the current price to that historical averaged earnings. And by taking a 10-year average, it kind of smooths out all the yearly volatility. So it's a tool that has become more and more popular over the last few years. Shiller's a Nobel Prize-winning economist guy. He's the half of the Case-Shiller Housing Index. I think he teaches at Princeton or something like that. It takes a look at that one, and we can see that the highs occurred in at times you would not want to be buying, because crashes happened soon after. There's the dot-com bubble, there's the financial crisis right there, there's the Great Depression and getting kicked off, there's the 1937, and then we've got Black Monday and all that stuff. So we've got 1987 right there, that little blip. And then there's another one, Hussman's margin adjusted price earning ratio. Similar idea, slightly different metrics. But so I think that's all well and good. But part of the problem with these very, very long-term viewpoints is that financial regimes change. So the monetary system in 1880 has very little to do with the monetary system following World War II with Bretton Woods, and has very little to do with the monetary system from 1971 when we went pure fiat under Nixon. So, and then, past 30 years, we've seen the increasing financialization of everything. So, the historical norms have changed. So it's hard to compare, just one thing like this point to this point over here and say, well, the average was down here. But, if we look at the averages, so if just eyeballing this, if we call this 15, right? So even during the depths of the crash right here, when the S&P got to 666, that might have barely touched 15. And, that's not as useful. So what I did was I went to, Yahoo and downloaded some stuff. And I got the CAPE going back to 1872, and what I did was I plotted a 10-year and a 20-year moving average. So the blue line here you can see is the 10-year moving average, and the red line there is the 20-year moving average. And it's interesting stuff. So let me move my little face out of here so that you can actually see the axes. I actually had not intended this to be any kind of signal, because this is sort of similar to MACD, the moving average convergence divergence signal. But in terms of the bull moves, that is, it's actually a pretty decent indicator. So this one went positive, where the 10-year crossed over the 20-year in let's go look, 1980 what? 1991, actually. Is that right? Yeah. So that actually would have been a pretty good time to buy stocks. Interesting thing to investigate for the future. But I just want to see, so in the last 20 years, let's say, from 2019 to 2000, we've been in a very unusual environment, historically. So, can we compare these times to these times? And it's hard. I mean, in shape you can certainly, because here's the Great Depression. We have the similar kind of behavior here as we see over here. But in terms of the absolute level, it's hard to say that is the same. So, I think we are in for a somewhat reversion to the mean, but I don't think it's going to get back to these kind of levels down here, just because of the different ways the financial systems worked in the world. Another thing I did was I downloaded the S&P prices going back to 1950, and then what I did was I plotted the 2-year format data series. Let's turn it on. Solid color. Okay, so let's turn that on, and let's turn off the moving averages. No line. And just so we can kind of see. Okay, so what this is the 2-year forward returns. So in the look at this first plot in 1950. This says if you bought January 1st, 1950, what was the return 2 years going forward? And the way the prices work from Yahoo Finance is that they are split adjusted and everything. So it should be a consistent measure. So the interesting thing here is that the 2-year forward returns, went negative when this peaked here, and went negative again at this little peak, and then those were the last two negatives. So, and then back here we had some negatives at these smaller peaks in the Cape. So what that's telling me is that there is a grain of truth to the assertion that paying elevated prices in Cape terms, whatever that means at the current time, is a reasonable indicator that your forward returns are going to be less. And you can play with this. Instead of a 2-year, you could do we could do a 5-year. Let's change that. Of course, you get less data as you do that. So let's see. So that's 2, 3, 4, 5. So that's going to be 85. And then let's go see what we see and say, oh, well, okay. So now, going forward, we have much more extreme trends. Here's the 0 line for this scale, and we can see that we went negative, earlier because the peak occurred within the 5-year window that we're looking at. So that would have been 1998 or so, and 5 years in the future, then your returns were negative, and they stayed negative for 3 years, and then they became positive, which basically is when you're buying. If you're buying at the dip, then hey, you did okay, and then they went negative again. So this whole time from 1998 to 2000 and let's see, what was it? 2007? Yeah, 2007. That whole thing was a bad time to be buying stocks, except for this 1 year of 2003, and that's to be expected. There was a giant crash there, and then there was a little bounce, and then there was another giant crash. So the problem with any kind of chart is you have to make decisions at the rightmost edge, right? That's what Alexander Elder says. So is this a positive return kind of environment? Well, maybe, because you can see here that it could go much higher. But is it a good risk-reward ratio? And to me, the answer is no, and that's why I am currently not in any equities. I'm waiting waiting for one of these, basically. I don't know if it's going to be this year. I don't know if it's going to be next year. I don't know when it'll be. But, you know, if we have a long enough time horizon, and fortunately I'm young enough still, you know, 40-ish, that I have the flexibility in order to you know, time my entries more. I mean, if you're closer to that retirement age, well, one, you know, you probably don't want to be as heavily in equities anyway. You want to be more on the fixed income side. But, you know, that's difficult too with interest rate repression and, you know, financial games that the central banks are playing. So, you know, you have to take these things into account. And I mean, this is a very big picture fundamental analysis, and you always want to look at the smaller picture and to actually time your entries and exits. But yeah, I mean, I don't think there's any other way to see it other than, yes, we have very high prices right now. So do you want to pay high prices and hope they go higher, or do you want to pay less high prices, at least on a relative scale that we're looking at in the recent history, and you know, stack the odds in your favor? Because that's really, when it comes down to it, you can only make your best educated guess, and as far as what's going to do well for investments and what's not. Nobody has a crystal ball. Whoever did have a crystal ball would be fabulously wealthy, and I would like to meet them. So other than that, you know, you just got to stack the odds in your favor. So the odds here are still telling me, despite the little dip that we've had lately, they're still telling me prices are too high.